When the market turns this ugly, nobody has time for nuance. If a company with a high-flying stock reports what's looked to be a flawed quarter, we're going to sell first and then ask questions later. We saw this play out in real time on Wednesday night with one of my favorites. It's Splunk. It's a cloud-based software analytics play. It's posted some what people thought were confusing numbers. I didn't. While the company delivered better than expected sales and inline earnings, management's guidance did fall short for some, both for the next quarter and the full year. In response, the stock plunged from 155 to 139 as of today. And it was already down $20 from its highs going into the quarter. However, I think this is a snap judgment, and it may be wrong. Splunk's in the process of changing its business model. Instead of selling software licenses, make up lots of money up front, they're prioritizing a subscription-based model that generates lots of recurring revenue. That's the metric. We've seen this transition before from other software companies. While it can be confusing at first, it tends to be very lucrative for those who stay with it. Don't take it from me. Let's check in with Doug Merritt, the president and CEO of Splunk, to get a better sense of the quarter and where his company's headed. Mr. Merritt, welcome back to Mad Money.
Thank you, Jim. Very excited to be here, and congratulations again on 15 amazing years.
You're very kind. Thank you, Doug. It was a big day for us. Thank you. Hey, I want to get right to it in the sense that I went over your quarter several times, and I try to do it without looking at the stock, Doug. And to me, you can correct me if I'm wrong, this is maybe your best quarter you've had, and I thought the guidance was good and strong. Now, am I just a dreamer, or because that was not the consensus view?
So, as you highlighted at the beginning of the show, we have been going through a transition from a perpetual license company to a renewable company. We've actually transitioned now 99% in Q4 of all revenue, all transactions to term and cloud. That's a huge shift. But within that shift, we also are growing a cloud business like crazy, from 0% of our business in ARR being cloud 5 years ago to 35% of software bookings being cloud. On an annual recurring revenue basis, it was a spectacular year, a spectacular quarter, and I think a phenomenal guide over the next 3 years. If you're looking at GAAP metrics when a company is going through a transition like we are, that's where I think people can get confused.
Yeah, let's go over this number, this ARR, the annual recurring revenue. This has often been the tell for me about when a company that's switching models is really about to explode in earnings, not go down. 54 would lead to me to believe that next year is going to be gigantic. That's the way it's worked. You and I have been around for a long time. We know that ARR is the way to judge the future.
I agree completely. If you go back to Q3 of last year, we had a 46% growth rate on our ARR. We just exited Q4 of this year to 54%. So we went 46, 50, 51, 52, 53, 54. Unbelievable growth. We guided to 45% ARR growth for this year in front of us, and a 40% compound annual growth rate, or CAGR, over the next 3 years. So if you look at a roughly $1.7 billion ARR posting, which is what we just did in this Q4, at a 40% CAGR, that gets you somewhere north of $4.5 billion over 4 years. When I look at other companies that are awesome category leaders that are fully ARR or subscription-based, like Salesforce or Workday or ServiceNow, that is a growth rate that is at or above anything that they've ever done in that same trajectory.
Yeah, okay, good, because what I think people, I saw this with Adobe too, and you had to get it ahead because when the analysts figure out, you'd always think that the analysts must know. It is amazing that they don't. Now, I'm going to talk about a customer that is a Jeff Bezos product, and we all know that Jeff's the smartest man around, and it's the Washington Post. So what does Splunk do with the Washington Post that Washington Post loves you so much?
Yeah, so as we talked about in the past, our three main buying centers are the cybersecurity team, the infrastructure team that's got to keep all the digital stuff running, and now with the acquisition of SignalFx and Omnition, we're going after the application development team. Washington Post is using us across those core use cases. They've got a really important new content management system, digital content management system, that we are ensuring stays up. But it's interesting because we're also helping them analyze the activity from customers across the content that's being published by Washington Post. So in addition to the keeping Washington Post running day in and day out, we're also helping them understand what customers are doing on a day in and day out basis with the content they post.
Okay, so let's just go there. We have to do the obvious because it's what's driving everything. Does Splunk have to be face-to-face with big deals? Because you have big deals. Can you really do them with a Zoom video? Or do we have to say, you know what, as long as this thing's going on, we got to work from home, make some phone calls, but we're not going to close anything big?
It's a brave new world, Jim. I think we're all going to learn this in the coming months. Like every other company, or I think like every other company should be doing, we're putting our employees' health and safety first. So we are encouraging people to work from home. Luckily, we are a Zoom customer, a Slack customer. There's a lot of great digital technologies that we can all lean on so we can still move forward with business. We've got a great install base, 20,000 customers that actively use Splunk. Over 80% of our revenues, which we've talked about for many years, come from that install base. My hope is that for a lot of the transactions, they're just expansions or additional capabilities from some new products that can be attached to the existing contracts. And we've already got a great relationship with the buyers and procurement. And we'll see. We'll see like we all do. I didn't think going into 2020 that I'd be the CEO of a company that was going through something like coronavirus.
Well, I mean, we don't necessarily see less demand for Splunk, do we, because of the coronavirus?
When I think out of the next 2 or 3 years, and even the next few months with coronavirus, we feed into this whole digital transformation movement. If this becomes a new normal and we start to adapt to more of a social distancing or whatever the vernacular is that's popular on today's Twitter feeds, that just means more digital usage. The companies that we are all relying on, all the digital properties have Slack as their backbone to make sure that their services work effectively, have Splunk as a backbone. So whether it's Slack or Zoom or AWS as a overall customer of ours, or a whole host of different Google properties or Facebook, so if we all turn digital, that for me falls into the trend we've been seeing, which is I now need to make sense of what's happening on that digital environment. I need to make it resilient. I need to make it safe, which means more Splunk.
My viewers are all going to say, what's Turing? Go ahead. Shirt. You always make shirts meaningful.
You know, the double entendres that we love, Alan Turing, and this actually was my walk-up music my first year as CEO to our sales kickoff. So it was the favorite I pulled out for today.
All right, it's good to see you smile. Thank you for your kind words about our 15th. And yeah, I didn't think that any illness is going to stop digitization. That's not the way it works. Thank you so much to Doug Merritt, President and CEO of Splunk. Good to see you, sir.
Thank you, Jim. Good to see you, too.
Okay, you have to understand that there are some secular trends that will transcend a virus. Will there be bad days? Absolutely. This stock has now given up as if what's happened is a virus shutting down their business. That's not going to be the case. Mad Money's back in for the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.